Well, good afternoon, everyone, and welcome to today's fourth virtual Lunch and Learn training session. And it's brought to you by the Southeastern chapter of the International Association of Financial Crimes Investigators. I'd like to thank the organizers of the event, including Tanel Harris of Wells Fargo, for welcoming us today. I'd also like to thank all the attendees and participants for your continued support of the IAFCI. My name is Dan Spuller, and I am the co-chair of the North Carolina Blockchain Initiative. From 2016 to 2020, I led membership and industry affairs for the Washington-based Chamber of Digital Commerce, and now I serve as an advisor to Fundopolis Securities and the Blockchain Association. Today's session, we're going to be examining several really interesting topics, and including the first regulatory clarifications for stablecoins issued by the SEC and the OCC. I'm honored to be joined by two distinguished speakers, Hailey Lennon, partner with Anderson Gill, and Mr. James Vivenzio, the Senior Counsel for BSA AML at the Office of the Comptroller of the Currency. We're going to start by having each one of them introduce themselves with you and to share with our attendees their background and how they became involved in this space. So let me go ahead and get started with Mr. James Vivenzio, who serves as the Senior Counsel again for BSA and AML at the OCC. James, in addition to yourself, could you also give your audience an overview of also what the OCC does?
Sure. I've been at the OCC for approximately 30 years, and for the past 15 years or so, I was the senior counsel for BSA AML in the OCC Law Department. And I'm currently in an acting role as the director for BSA policy. I got involved in cryptocurrency and electronic banking, back in the late 90s, back when the Y2K issue was exploding, because of my expertise in BSA AML, I've been involved in a lot of the digital issues and electronic banking issues and cryptocurrency issues. Mainly because of the significance of BSA and AML and, the transparency issues that go along with, many of these, new technologies, as well as, some of the well-documented fraud cases that have also been taking place. But anyway, what does the OCC do? The OCC is an independent branch of the Treasury Department. The OCC charters, regulates, and supervises all national banks and federal savings associations, as well as federal branches and agencies of foreign banks. There are approximately 1,700 institutions under our supervision, including many of the largest banks in the United States. And our agency is comprised mostly of national bank examiners that examine these banks for compliance with the laws, as well as for safety and soundness.
Thank you for that, Jim. Hailey, why don't you go ahead and introduce yourself?
Sure. Well, happy to be here and nice to speak with you all today. My name is Hailey Lennon. I recently joined Anderson Gill as partner in their technology legal practice. My focus for many years has been on the regulatory and policy issues in the cryptocurrency and digital asset space. I'm currently also a contributing writer for Forbes and Bitcoin Magazine, where I explore some of these topics, including things we'll be talking about today. I spent most of my time in the cryptocurrency space as in-house counsel. Most recently, I was regulatory counsel for Coinbase, a leading cryptocurrency exchange here in the United States. And before that, legal advisor for Bitflyer, an international exchange, and Silvergate Bank, which is a leading cryptocurrency bank located in San Diego. So I've spent many years in the space exploring the regulatory implications of digital currency, seen the evolution and cooperation the industry has had with many regulators, including the OCC. And so really excited to talk about some of these exciting developments that have happened this year in the space.
Thank you, Hailey. So for our first question, Jim, I want to direct it at you because about 1 month ago, your agency, the OCC, you published fresh guidance officially clarifying national banks can provide services to stablecoin issuers in the United States. I'd be curious to hear a high-level overview of that letter, and maybe you can clarify the OCC's approach.
Sure. So yeah, about a month ago on September 21st, the OCC issued interpretive letter 1172. Essentially, the OCC determined that stablecoin issuers may place assets in a reserve account with a national bank to provide assurance that the issuer has sufficient assets backing the stablecoin. So a national bank is able to hold these stablecoin reserves as a service to its bank customers. And the legal authority that the OCC relied on in the letter is that national banks are expressly authorized to receive deposits, and deposit taking is a core banking activity. Interestingly, the stablecoin letter that was issued in September, it referenced the OCC's cryptocurrency letter that was issued in July, where the OCC reaffirmed that national banks may provide permissible banking services to any lawful business they choose, including cryptocurrency businesses, so long as they effectively manage the risks and comply with applicable law, including those related to Bank Secrecy Act and anti-money laundering. There were some limitations that were expressed in the stablecoin letter. Specifically, the OCC did not presently address the authority to support stablecoin transactions involving unhosted wallets. As many of you know, cryptocurrencies are generally held in wallets, which are programs that store the cryptographic keys associated with a particular unit of a digital currency. And a hosted wallet is an account-based software program where the keys are controlled by an identifiable third party, like Coinbase. These parties then receive, store, and transmit cryptocurrency transactions on behalf of their account holders. The account holder generally does not have access to the keys themselves. There's also a second limit that's in the stablecoin letter, and it specifically addresses the use of stablecoins that are backed on a one-to-one basis by a single fiat currency, and the bank verifies at least daily that reserve account balances are always equal to or greater than the number of the issuer's outstanding stablecoins. These two limitations or guardrails were included in this permissibility letter to ensure that certain safety and soundness issues, as well as transparency issues, are addressed by banks wanting to get into this area. The stablecoin letter also describes some of the applicable laws, it specifically notes FDIC insurance, and as with any deposit product, a national bank or a federal savings association that accepts reserve accounts, they need to be aware of the laws and regulations relating to deposit insurance coverage, including the limits and pass-through requirements, if applicable. The letter also mentioned Bank Secrecy Act, anti-money laundering, and it noted that a national bank must ensure that it establishes and maintains procedures reasonably designed to assure and monitor its compliance with the BSA and implementing regulations, including but not limited to the customer due diligence requirements, the customer identification requirements, and any beneficial ownership requirements for any legal entity customers opening accounts at the bank. I just want to point out there that who would be the customer that would open the stablecoin at the bank, and the customer would be the stablecoin issuer. And BSA laws generally focus on customer relationships. since the issuer of the stablecoin that is, opening up the account at the bank is also likely to be a money services business based on FinCEN's interpretations of their rules. Because the customer is a money services business, there is specific guidance that we put out in 2005 to banks on providing banking services to money services businesses. And that was interagency guidance issued by the federal banking agencies and FinCEN. And so that guidance would also be applicable here, since, again, it would be the issuers of the stablecoin that would be the bank's customers that are establishing these reserve accounts. And the letter also mentions securities laws and points out that a national bank must also comply with any applicable federal securities laws and how they may apply to a stablecoin issuance. And then the third component to the letter is risk management. And the letter notes that new bank activities should be developed and implemented consistently with sound risk management principles and should align with the bank's overall business plan and strategies. The letter also points out specifically that the reserves associated with stablecoins could entail significant liquidity risks. For example, there could be a sudden influx of redemption requests, resulting in a significant outflow of deposits from the account. The OCC expects all banks to manage liquidity risk with sophistication equal to the risk being undertaken and the complexity of the exposures. The letter also gets into some of the appropriate contractual agreements that need to be in place with a stablecoin issuer that governs the terms and conditions of the services that the bank provides to the issuer. And the letter provides some insights into these agreements. It specifically provides that the agreement may include contractual restrictions or requirements with respect to the assets held in the reserve account, specify the respective responsibilities of the parties, such as the steps the parties will take to ensure that the appropriate party will be deemed the issuer or obligor of the stablecoin, should enable the bank to verify and ensure that the deposit balances that are held are always equal to or greater than the number of outstanding coins, and also include mechanisms to allow the bank to verify the number of outstanding stablecoins on a regular basis. Mm-hmm. And it specifically notes or references the OCC's, I should say the federal banking agencies, prepaid card guidance, the applicability of the CIP rules to prepaid cards. And in that guidance, it specifically contemplates that banks would enter into contracts with third-party program managers that permitted the banks to audit the third-party program managers. So I thought that that was interesting as well.
So, and I wanted to see if we can let Hailey get in on this if you'd like, or Hailey, I can jump to your question.
No, I mean, I think a lot of what we're discussing is the OCC's valiant attempts at adding some clarification on ways in which banks can safely be a part of this industry. And so one thing that struck me that was mentioned is the fact that the single fiat currency as a backing mechanism for a stable coin. There's been a lot of news over the last few years, including the Libra Association and their efforts to make a stable coin. At first, when that topic was introduced, it was more in terms of a stable coin with multiple different currencies backing them, sort of a basket of currencies. And so, I think that there's various ways in which stable coins can function. And the OCC is providing very helpful guidance on ways in which a stable coin needs to be backed, how it needs to be issued, and the type of program the bank needs to maintain in order to safely, as they mentioned months ago, custody digital assets and now support stable coins. So that's a really helpful insight on how that how the guidance is coming.
Yeah, I would agree. And Hailey, about 2 months ago, you and I held a real informative conversation, a fireside chat like this with Ms. Gravetta Gardiner, who's the Senior Deputy Comptroller for Bank Supervision Policy at the OCC. Of course, this was shortly before the new guidance was released. And since that time, you've joined the law firm of Anderson Kill and are now a partner in their blockchain and virtual currency group. First, congratulations. And second, I'm curious as to your take on the OCC's approach to crypto and stablecoins. Maybe you can explain that a little bit.
Yeah, I mean, so I bring an interesting perspective to this in the sense that I started, as I mentioned, at Silvergate Bank. And what Silvergate Bank is not a national bank, but they were the first bank to try to determine how to safely provide bank accounts to digital asset customers. And as Jim mentioned, in that case at Silvergate, most of the clients we were banking were cryptocurrency exchanges, which are money services business. And there's almost a not just know your customer, but like a know your customer's customer. With an MSB, you really need to be ensuring that the money services businesses that you're providing bank services to have their own anti-money laundering program in place. It's sort of two layers of that. And so coming from that, and then also from the perspective of now a law firm servicing customers in the space, being at Coinbase and Bitflyer that are exchanges, I've been very excited by the OCC's guidance and clarification. I think that it's allowing, it's allowing larger traditional banks and financial institutions to feel perhaps more comfortable getting into the space, understanding that as long as they are providing banking services to legally functioning companies with appropriate risk management and compliance programs in place, that is the service that they are able to provide. And so when the OCC provided that guidance a few months ago about being able to custody digital assets, being able to bank digital currency companies, and now the guidance on stablecoins, I think it's all a great thing for the industry and just our sort of financial innovation in the United States in general. But what really spoke to me in this conversation thus far is the only way you can have that financial innovation is ensuring that financial institutions are supporting innovation in a careful way. And so establishing programs to ensure compliance with BSA, AML, that has to be a part of it. And so the continued guidance from the OCC only helps financial institutions ensure they're able to do that.
Thank you.
So yeah, I mean, I really appreciated, Jim, your feedback on sort of how these letters are coming about. I know, as we've talked about, there's been guidance on the custodying of digital assets, now stable coins. Are there any aspects to the approach the OCC is taking, or just the way in which you view the BSA, AML aspects of this space that are impacting the way in which the OCC is providing guidance?
Yeah, the one pattern is that you can pick up in these letters, and not only the stablecoin letter and the crypto letter, but back in December, the OCC also issued a structuring SAR letter. Interpretive Letter 1166, which permitted the use of innovation in the identification and filing of structuring SARs. Structuring transactions, as you all know, are transactions that are designed to fall under the $10,000, cash transactions designed to fall under the $10,000 filing threshold. And the reason I point that out is all three of these letters kind of have the same consistent approach. And the first is the permissibility of the activity and the focus on the legal permissibility, whether it's a core banking activity or incidental to the activity. And then the second interesting element to all three of these letters are the guardrails. The specific rails that the agency puts in place to ensure that the activity will be conducted in a safe and sound manner. I'd mentioned in the stablecoin letter, two of the limitations there: the 1-for-1 ratio to fiat currency, and the use of hosted wallets. Similarly, in the crypto letter, there was the reference to what was that, hot wallets versus cold wallets, and kind of pointing out some of the challenges there with regard to how the assets are stored. And then the crypto letter also kind of pointed out that the two different types of storage where the bank actually obtains the currency so that it has its own private key, or there are other specific controls with regard to that private key that are in place to ensure that the asset can't be compromised or negotiated. And the crypto letter also then talks about just a straight safekeeping type arrangement, where the bank is simply provided with a copy of the keys, but those keys are also being held by the customer. So there's no way that the bank can really securely hold those assets. So that needs to be spelled out in the contractual relationship to ensure that the bank is not held liable under those situations. And then the structuring SAR letter also had these guardrails in place to make sure that in those situations where the transactions might involve more than structuring, that those types of transactions get pulled from the process and are subjected to a more scrutiny or a manual investigation process rather than going through just an automatic process with automated SAR filings. So that's kind of, I just wanted to point that out. I think that's an interesting component or element to these letters that the OCC is putting in place. And then the third common characteristic in each of these letters is ensuring risk management processes are in place at the bank. Ultimately, the bank is responsible for these activities and making sure that they're conducted properly with policies, procedures, processes, and where appropriate. As I pointed out in the stablecoin letter, we are also going to provide some guidance there as well with regard to some of the contractual provisions and the liabilities and the risks and specified audit recommendations and things like that, in order so that these new technologies are done properly, and with the requisite level of expertise that's needed for a bank to do this, not only in compliance with the law, but also in compliance with safe and sound banking practices.
Well, that's interesting. That's quite an interesting perspective, Jim. Hailey, you worked at a bank and an exchange and now at a law firm, and so you've clearly seen the industry from a variety of angles. Let's talk about the industry for a moment. How does the OCC's news impact the industry as a whole from your perspective?
Yeah, I mean, it's interesting. I think what strikes me the most is the guardrails we were just talking about. I think in any industry, when there's a new technology, those sort of guardrails and things, attributes of a technology that allows for the safekeeping or, careful, compliant manner in which a company approaches this space is really helpful. And you can tell from the OCC's guardrails that this is an area that they are knowledgeable about. These letters are not sort of high level thoughts on the space. They're getting into the one-to-one backing and aspects of this cold and hot storage that, it's a lot of regulators are still wrapping their heads around. So I was impressed by that. To me, what the these letters are helping accomplish is for there to just be a bit more acceptance and support of digital assets and stable coins in traditional finance. Last week we even heard that PayPal is going to start supporting digital assets. That's under a different licensing structure with the New York Department of Financial Services and their conditional bit license. But we're seeing a move away from the narrative that digital assets and stable coins, there was a narrative that those assets pose a money laundering risk that is not something that can be mitigated. And I think that the guidance we're seeing and the general approach other regulatory agencies are starting to take in the space is there are unique risks with digital assets, but there are ways to mitigate around those and to support the industry in a safe manner. And so, I think the OCC's guidance is just another layer of that in terms of giving the industry more tools to utilize, giving financial institutions more guidance and guardrails, as we've been discussing, to have a new approach on the space. So I think it'll be really interesting to see where it all leads.
Yeah, on that topic, I recently read a Forbes article written by my friend Matt Hogan, who's at Bitwise Asset Management, and the title was "The OCC's Notice on Crypto is a Really Big Deal," and he commented on the agency's remarkable progress. I should say it's progressive embrace of the crypto industry, and so it explicitly permitted banks to both custody crypto assets for customers and provide banking services for crypto-oriented businesses. Do you share that sentiment?
Yeah, definitely. I mean, I think these are all noteworthy advances that, and it's bringing just a certain level of clarification from the OCC that's noteworthy and important to the industry. I mean, this sort of clarification is one that just can help give companies and financial institutions a peace of mind if they are interested in dipping their toe in the water and starting to explore ways to get more into the digital asset space. I mean, obviously, as someone who has sort of committed my career to this industry, I believe in it, and it's exciting to see where it goes. So I definitely share in that sentiment. It is exciting.
And on the topic of opinion pieces, Jim, I read recently also some op-eds that were put out by the American Banking Association, commenting on that only Congress can define a bank. Of course, the OCC claims that you do indeed have blanket authority under the National Bank Act to define what it means to be a bank. Can you respond to that?
Sure. The OCC has the authority to grant a national bank charter, to any entity that is engaged in the business of banking. And we've had that authority since the National Bank Act in the 1860s. Our current focus, and as directed by Acting Comptroller Brooks, has been on reviewing our supervisory framework to ensure we have an appropriate framework to supervise companies engaged in payment services, which is a core banking activity. And the principles that we're using in this review are that companies that are engaged in banking activities should be supervised as banks, and that consumer protection, financial inclusion, and fair access will be at the forefront of our supervision, and that entities engaged in payments activities that seek to become a national bank should be supervised like similarly situated existing national banks. And as with all our institutions, our supervision is tailored to the risks and the business model of the particular institution. The charter comes with responsibilities and obligations that all national banks would have, including compliance with capital rules and BSA AML obligations. And as I pointed out earlier, establishing governance and risk management frameworks, and financial inclusion considerations and requirements. As you know, there's litigation in this area, and I'm unable to comment on the specifics of the litigation. But I can say that the OCC believes it has the authority to grant national bank charters to companies engaged in banking, but do not take deposits. And we have appealed the related Southern District of New York ruling.
Okay.
Yeah, I think it's an interesting space in terms of I've always thought that the regulatory space of cryptocurrency in general is interesting because there are so many regulatory agencies that do have a say. In terms of the guidance from the OCC, to me, it seems not as an expansion of a definition, but more just a clarification that the technology is evolving, and as a result, so is what constitutes sort of providing banking services. So, so I would, reiterate that point. So maybe moving beyond this topic of stablecoins and the guidance that the OCC has provided, I know that the OCC recently took an enforcement action against MySafra Bank, and that was in general sort of for engaging in cryptocurrency services without sufficient controls. Can you provide a little bit more insight? I believe you were involved in part in that enforcement action. I'd love to understand the intricacies of what those deficiencies or sufficient controls were, and how that really involved cryptocurrency.
Sure. Again, the focus, of getting involved in some of these activities, needs to be that you're going to do it in compliance with the laws and the regulations. What happened in the MySafra situation, it was interesting. There really weren't specific breakdowns per se with regard to the cryptocurrencies, but instead the action focused on other areas of the bank that was impacted as a result of their cryptocurrency and their MSB products. So what happened is that other areas, for example, their wire transfers, their international wire transfers, and their ACH activities increased significantly. That's where some of the breakdowns occurred at the bank. In addition, the enforcement action also points out that there were, other breakdowns with the bank's BSA compliance program in the areas, if I recall, internal controls and BSA officer and testing. Ultimately, all of these breakdowns contributed to what we call as a BSA compliance program failure. And when a bank has that type of a failure, the OCC is required under the law to impose a cease and desist order against the bank. So that's what happened in the MySafra situation. It was kind of, like I said, it was interesting. It kind of just shows how, when a bank gets into one product or line of business, that ultimately it can have impact, unanticipated consequences in some of the other banks' lines of businesses, and that's where the breakdowns took place.
Yeah, it's interesting. I mean, it makes me wonder. I think it seems like some of the issues that the bank was facing in terms of their compliance failure likely would have existed without the involvement of cryptocurrency as part of their service offering. Do you see it that way, or how do you feel the cryptocurrency played a part in some of that failure?
Yeah, I mean, the BSA compliance program is applied on a risk basis, I don't think you can make that conclusion. Because ultimately some of these areas that I mentioned, ACH, wire, international wire, may not have had the volumes prior to those customers coming on board. So again, when we analyze a program, it's really based on risk, and clearly the risk increased as a result of the activities that they engaged in.
Yeah, that makes sense.
Sorry, I was on mute there. Earlier in the conversation, you alluded to the OCC's, back in June, the advanced notice of proposed rulemaking on digital assets. Could you expand on that for the audience?
Sure, I can talk about that. And what's important about that document is, it's really a two-pronged approach that the OCC has been using with regard to technology. I pointed out, three significant interpretive letters that have come out of the OCC Law Department, essentially interpreting, our existing regulatory framework and how that can be flexibly applied, to these new technologies. But the second prong that we have, are our actual regulations. So as opposed to legal interpretations, we're also looking to update our regulations with regard to digital banking. And our original electronic banking standards are in our Part 7 section of our regulations, and Part 7 is a very broad compilation of legal interpretations and regulations, and these interpretations have actually been turned into regulations. And the standards were developed many, many years ago. And so we're now in the process of bringing them current. I previously mentioned my experience with Y2K, and I think that's about as how old these electronic banking standards are. So anyway, some of the questions that we requested comment on, and we put the notice of proposed rulemaking out on June 4th, specifically requesting public comment. And two of the comments were specific to cryptocurrencies. And we asked what activities related to cryptocurrencies or crypto assets are financial services companies or bank customers engaged in? And what are the barriers or obstacles to further adoption of crypto-related activities in the banking industry? And we also asked, how is distributed ledger technology used or potentially used in activities related to banking? And so those were the two crypto questions. And then more broadly, we asked several other questions, whether or not the legal standards in Part 7 are sufficiently flexible and clear in light of the technological advances that have transformed the industry over the past 2 decades, whether these standards create unnecessary hurdles or burdens to innovation by banks, whether there are digital banking activities or issues that are not covered by these rules that the OCC should address. For example, digital finders activities, certain software and correspondence services. How are artificial intelligence and machine learning techniques used or potentially used in activities related to banking? And that's also very, very relevant for BSA purposes as well. We're seeing, a lot of potential developments in BSA using machine learning and artificial technology. And then just some broader questions: what new payments technologies and processes should the OCC be aware of, and the implications of them for the industry? What new or innovative tools do financial services companies use to comply with regulations and supervisory expectations? If there are any issues that are unique to smaller institutions regarding innovation in products, services, or processes that the OCC should consider, and changes to the development and delivery of banking products, as well as if there are any issues that we need to consider in light of the COVID-19 pandemic as well. So anyway, we put that document out on June 2nd. Comment period is closed on August 2nd. And so we are in the process now of evaluating all the comments that we received, and looking at some possible regulatory changes that would also advance the ball in this space. So like I said, it's a two-pronged approach. We've got the legal interpretations as well as possible changes to regulation. Regulations are significant. They trump guidance and ultimately should provide a lot of help in this space.
Yeah, I'm glad you brought up those emerging technologies, including machine learning, artificial intelligence. I mean, even beyond blockchain and digital assets, this world's changing very, very fast. And I think it's important that all financial institutions are well aware of what's going on. Hearing it from you is very helpful. It's good to know that you're working on that as well. There's a topic, Hailey, that I didn't think we'd get to, but in light of the news last week, FinCEN, of course, and the Federal Reserve, they're interested in making some changes to the travel rule reporting. And these proposed changes are going to require financial institutions and crypto firms to share data on international funds transfers above $250. I'm curious to see if you want to weigh in on that.
Yeah, so for anyone in the audience not innately familiar with the travel rule, it's this idea within traditional finance of two regulated financial institutions passing along beneficiary and originator information in between two parties. FinCEN and FATF have both been very clear that this also applies to the cryptocurrency space. How to comply with that is a little trickier on the cryptocurrency side, in part because there aren't as clearly defined financial institutions. What FATF and FinCEN are calling VAS are, a variety of different types of companies in the industry that would need to comply with this. So that has always been the case. What you're referring to is last week FinCEN proposing to lower the travel rule threshold from $3,000 to $250. Clearly, that would make the reporting and travel rule requirement apply to a lot more situations. I think right now what, to keep it to the cryptocurrency space, what the space is grappling with is the cryptocurrency industry doesn't have the equivalent of sort of a SWIFT or a way in which to easily and safely comply with passing customer information from one company to the other. That said, FinCEN and FATF are clear that the industry needs to comply. So that the first step is continuing to collaborate as an industry to determine the best way to handle that. In terms of lowering the threshold, I personally am not sure that is necessary or will adequately increase any sort of anti-money laundering concern protections. But I think it's just it just shows that the Bank Secrecy Act and anti-money laundering and also inter-regulatory relationships, including between FinCEN and FATF, continue to be an important topic. We'll see, what happens with the news from last week, but the regulation is not going anywhere, and the crypto space is no exception to an industry that is heavily regulated. And so I think we'll just continue to see how the OCC, FinCEN, FATF, and other regulators continue to regulate the space, keeping us all very busy.
For sure. This was certainly an interesting conversation, and unfortunately, we're coming towards the end of the time slot. And I'm sure our audience has many more questions that we couldn't get to today. But if they do have any questions, I would encourage you to contact Jim, Hailey, or myself via email, or contact Tanel Harris. We have our emails available in the program, and we'll be, of course, happy to respond to those as soon as possible. Any concluding thoughts from you, Jim or Hailey, as we wrap this up? Just a couple of interesting developments in the when looking at these activities, as well as when these activities are being conducted through a money services business, is the difference in the application of the BSA to
banks as compared to money services businesses, and I think I think that's kind of an interesting development, because the big difference really is the fact that banks have customer relationships, and that's significant, and many of the BSA laws focus on customer relationships. For example, the customer identification program, customer due diligence, beneficial ownerships, not customer specific, but doesn't apply to MSBs. Correspondent banking in Section 312 of the Patriot Act doesn't apply to MSBs. And so there is a very different legal framework for the BSA, for banks, because of the customer relationship versus MSBs, which may not have customer relationships and instead focus more on transactional relationships. So it's kind of a big distinction. And as a result, the MSB rules, are different. Rather than a CIP rule, customer identification program rule, there is a verification of identity requirement in the MSB program rule, but it's not quite as comprehensive as the bank's customer identification program rule. In addition, instead of there being a foreign correspondent banking requirement for MSBs, there are agent provisions in the MSB program rule. So the differences in the two industries are interesting. And then one other significant difference is the fact that MSBs have a SAR filing threshold of only $3,000 as compared to banks, where the threshold is $25,000 when there's no suspect identified. So these are all interesting distinctions and differences between the two industries that I just wanted to point out. And then finally, I neglected to mention the interagency statement on innovation in the bank secrecy area that the federal banking agencies and FinCEN put out about 2 years ago. And I just want to highlight that particular document because it's really a significant document. It encourages innovation and notes that banks won't be penalized in situations where they do integrate innovation into their programs, and it might result in the identification of activity that previously may have been missed, when their systems weren't quite as sophisticated, and also it's just a seminal moment for all of the federal banking agencies as well as FinCEN to come out in support of innovation in the BSA space. And that's a huge point, especially in light of some of the new changes that may be implemented by FinCEN to the BSA compliance program rule to focus compliance programs on the effectiveness of the particular program, with effectiveness being measured based on the program considering national strategic priorities. There's a lot going on right now with regard to innovation and effectiveness and compliance programs, there's going to be a lot of work for everybody in this space going forward. Thank you.
Thank you, Jim. Thank you. Hailey, do you have anything else before we wrap it up?
No, I agree. I think I already made the joke that we'll all be very busy with the financial industry in general and cryptocurrency. I really appreciated hearing both of your insights today. Thank you for having me. I am excited about what the future holds for digital assets and stablecoins. So To be continued.
Well, I couldn't agree more. We're all really excited about the future. And again, thank you to the IAFCI, to Nell and your team, and Southeastern chapter. This was a terrific opportunity. We really appreciate it. I hope everybody has a wonderful rest of your week. And again, don't hesitate to contact us or any of the panelists, and we'll be glad to answer any additional questions. Thank you.